Basically, what I want to speak about is bank lending and the current state of bank lending, savings account, and everything around it. On a quick note about myself, I run product and partnerships at Mode. We just launched the first multi-currency banking app here in the UK that offers a full Bitcoin bank account as well. Basically, from next week on, you can also earn interest on your Bitcoin holdings with our Bitcoin jar. And we also have a booth back here, so if you want to have a chat about that, have any questions, please feel free to come by. So while I was preparing for this presentation, actually, I was sent a quote which I thought sums everything up quite nicely. It was done by the Deputy Governor Financial Stability of the Bank of England, and basically what he's saying is bank lending could dry up in a crypto economy. So I thought this is actually is quite interesting, and I want to kind of unbundle this whole sentence, because the bank lending part, if you look at this, captures everything around savings accounts. So I want to look at what value does a savings account add for retail customers. Dry up, what does he mean by that? Is it only referring to liquidity, or what is actually the current state? Is it actually the landscape dry at the moment? And cryptocurrency economy, I want to kind of make sure we're using the right terms here, because it's often being used as a kind of collective term for stablecoins, Bitcoin, central bank digital assets. So I want to speak about crypto lending and especially also interest-bearing accounts for crypto assets here. So let's dive in it. If we look at why people and retail customers in the current time actually use savings accounts and bank lending, that's what he's referring to. So we're seeing that passive investments in general are very popular. They're becoming increasingly popular, and the majority of this is actually in savings accounts. We have in the UK around 58%. And interestingly enough, the overall UK household deposits are increasing for the last decades. We now have over 1.2 trillion stored in cash savings accounts. So before we dive into crypto lending and how it could pose a threat to that, I think it's interesting to quickly look at how a savings account works. So from a product perspective, you have a regulated bank that takes in deposits from a retail customer, and they pay an interest. That's the product, right? How they can make this happen on the other end is they lend out the funds to borrowers, retail borrowers or other borrowers, and they pay them an interest in return. And they take a cut. They allow themselves to take a cut because they assess the credit risk. They do some other services as well. They match different durations, and also they need to obtain a license, and they need to maintain the license and comply with different rules, and that's just costs. So they're charging you something for that. What's interesting here to see is that the amount that is deposited from retail customers and the amount that's being lent out is actually not the same. Actually, it's substantially more. So the whole system basically is leveraged. Why do users choose savings accounts? So why is it still an interesting product for them? So we identified 4 major points here. So first of all, it's safety. So technically, interest account, savings account should be safer than hiding the money under your mattress. Fair enough. Second aspect is liquidity and accessibility. So you should be able to, compared to other investments, just immediately withdraw your funds if you're in need. Thirdly, there's the guarantee. So in most countries, there's the government basically gives you a guarantee up to a certain amount. It's 85K in the UK of your funds stored in bank accounts if the bank went bust. And lastly, probably the most important part is the interest. So compared to hiding it under your mattress, you actually earn interest on it. So if we look at these 4 points and how convincing they are from a product perspective and what the current state of these 4 factors is, we need to ask ourselves actually if the bank lending and the savings account landscape is actually already pretty dry and is not being dried out. Let's look more closer into this. I want to start with liquidity and accessibility. So if you look at the top 100 savings accounts and make an analysis of them, in the UK, you find that actually top 20 savings accounts either limit the number of withdrawals or charge a penalty, cut your rates when you withdraw above a certain amount. So you have these terms that are about easy access that actually don't really hold true. It's more like a buzzword in that sense. Next part is the guarantee that we spoke about. We found that actually this is the most convincing part for retail customers to store their money in a savings account and with a bank. There's a huge controversial topic around this, which I don't want to dive into now because it would kind of be on the scope. But there's a debate around the effectiveness of the deposit protection scheme, and if it could actually hold when we have a larger, a larger kind of a doomsday scenario. So, for example, in the US, only 1.3% of the assets would be covered if all banks went bust. That creates obviously a moral hazard for banks, and also there's some indirect costs through that being passed on. But as I said, it's very interesting to read into this. It's just in general, there's a debate around this. The next point is probably most importantly the interest payments. So at the moment, interest for savings accounts are at an all-time low in UK and Europe. In Germany, for example, we have over 40 banks charging you negative interest rates, which means they charge you to deposit your money, which is absurd. And that doesn't even account for inflation. So if you also account for inflation, the real returns are actually negative in most cases. So there's a study as well for the average UK saver, which has around 25,000 in their savings account. They lose £500 a year if you account for inflation. So if you look at all of this together, objectively, and also for me as a potential customer, I would say that this is not really attractive, and I would say that it's already pretty dry. If we look into it further, I want to see this is not only that they fail to serve current customers with like traditional conventional assets. We see that we have new asset classes emerging that are actually gaining popularity, and we see, for example, here this is the top 10 equity holdings in self-directed brokerages accounts in the US, and we see that for millennials this year the Grayscale Bitcoin Trust made it to the top 5. So it's definitely gaining popularity. Bitcoin and digital assets are becoming more and more important for millennials. And why is this important? Because millennials are becoming more important. We will have a wealth transfer of 85 trillion to the millennials, and they're the fastest growing demographic, and they will receive wealth, they will inherit wealth in a way that has never been there before. And the interesting part is that banks, additionally to what I've mentioned before, they also fail to provide basic banking services to these new forms of customers. So for example, if you have a lot of Bitcoin, they would not consider it as wealth, and they would not, for example, accept it as collateral for a loan. So if you take this into account, that they're basically failing to provide competitive products to existing customers, and they're failing to provide any kinds of products to new customers, you definitely see that new entrants, new players are coming to the space, and they could take some market share. So let's look into that. We have on the one side, we have private crypto lenders. So here the concept is they accept new forms of collateral for loans, like Bitcoin, for example, and they also pay interest on new forms of assets. So you have interest-bearing accounts for crypto assets, for example, as well. They manage the credit risk, and you rely on them to manage the credit risk, or the collateral management in that sense. Then also on the other side, we have DeFi lending systems. So here, everything around collateral management and also the liquidations, payouts is done via smart contracts, and you basically don't trust the centralized counterparty with all of that. And also the overall collateralization ratio is actually, in fact, transparent. I will focus more on the private crypto lending side because we've had amazing talks here about the DeFi lending space already. So I just want to dive into quickly how this actually works. So just a quick recap. For bank lending, we have a bank that manages credit risk. It's leveraged, and you believe in the bank's ability to manage the risk. On the other side, if it comes to crypto-backed lending, you would have a Bitcoin, new form of customer, Bitcoin deposit as collateral. You receive a loan, which is in cash or in stablecoin, and they pay an interest for that. Compared to the banking model that we had before, this is actually only a fraction of that. So the loan is over-collateralized. For the lender, it's less risky, because if the value of the collateral drops, they could liquidate the collateral. Interesting part is this. They can, similar to banks, they can get the liquidity through stable coins for this, and they pay actually a very attractive interest rate to retail customers. So this is a new form of crypto lending emerging, which is actually very competitive in terms of a business to banks. There's another way. For example, in our Bitcoin jar, you can deposit any sorts of assets, like for example Bitcoin here, earn interest on it, and on the other side, there's basically a lending mechanism with various institutional counterparties that deposit collateral like stablecoins, and they borrow the Bitcoin. You have hedge fund, market makers, other forms of institutions. Yeah, so these are new types of products. Just want to dive quickly into how are they better. In general, as I just briefly described from a business perspective, these loans are over-collateralized. So if we had the bank example where everything is leveraged and you believe in the bank's ability to manage all this risk, here you actually have over-collateralized loans. In the DeFi space, actually, you see the overall collateralization ratio of the overall system. Second point, you have better products in general. So these are tech companies, fintech companies. They just adapt quicker to new needs of our customers. And also, I mean, if you look at the interest rates in interest-bearing accounts, currently they're just substantially higher than anything you can get in a normal retail banking space. Also, you can sign up with most of these products. You can sign up instantly. You can access it 24/7, and that's just better way of delivering products than banks. Last point here, I would say, is the global reach. So with a retail bank, you have a limitation of basically the bank being in one specific country, and you might be able to access that product or not. Here you theoretically have a global reach to everything. Obstacles. So you need to create trust in these new companies. So these are basically startups. Banks have had years and centuries to establish themselves as brand. They're sponsoring events, and the crypto space has trust issues in general, and this will just take time for these companies, these products to be accepted. Second part is there's a lack of regulation. There is no traditional banking regulation in the space. With a retail bank, you basically trust, as we said before, there's a guarantee, a protection scheme, and also you believe in the bank because they're regulated. You don't have this in the crypto space currently. Third part is custody issues. There's no real all-in-one solution for all these different points that you tackle. So you need to trust someone to manage the credit risk and also the custody of your assets. So all this combined, we see that there's still some obstacles that we need to overcome in order to make these products available accessible for the public. Quick thing to start to finish off with. I want to see where we are currently in terms of sizes. So this is a snapshot of end of 2019. For everyone who is in DeFi, you probably know that we've reached the 1 billion mark. This is in pounds, and this was end of 2019. Amounts of funds being locked in DeFi. If we look at private crypto lending, it's even further than that. 1.7 billion, also snapshot. It's very difficult to compare these numbers because the lenders are private. You need to basically believe what they're saying, that they have already lent out. So put things in perspective. Another thing to put into perspective, only UK cash savings account, compared to other products that could basically have a global reach, are at the moment at 1.3 trillion. So if they only captured a fraction of this market share, there's still a long way to go and to grow for private lenders and DeFi as well. What do we need to get there? Basically, we need to, in general, drive crypto adoption for retail customers. The space needs to grow, and also the infrastructure needs to become more sophisticated. Second part is UI, UX. Most of the products, especially in the DeFi space, are just very difficult to use, very difficult to navigate, overly technical. So there needs to be definitely improvement in terms of UI and UX. Third part is regulation risk management. We need to establish some sort of standardized way to compare risk between lenders. So we have this in the banking space. If it works or not is the other question. But if we managed to establish this, this could drive the whole lending ecosystem. Fourth part is, as I mentioned before, the whole space and the crypto lending space needs to kind of create some sort of trust around the industry, and this is also what we are trying to do with Mode, with our app, with our Bitcoin jar, and we're trying to bring these actually really for the customer really beneficial products. We're trying to bring this to a wider audience than people that are actually already in crypto. So everyone should be able to transfer in their funds, buy Bitcoin, and also earn interest on their Bitcoin and on stablecoins. This is what we're trying to do. We have a booth here. If you want to come by, if you want to download the app, just come by, ask us questions. Happy to answer all of them. Thanks a lot for your attention.